Hey, what's up, guys? And today I want to talk about how inflation it's coming to an end with or without Fed's help. I'm going to help you forecast what is the inflation going to be like in the coming months, so then you have a good idea of it. So without further ado, let's get started. In this video, I'm going to go through one of the economic lessons, I guess, I went through in Investing Accelerator weekly group coaching call. So every week in Investing Accelerator, we analyze the markets and what is the thing that is impacting the market and how to think about it for the coming months. And right now, Powell just increased interest rate by another 75 basis points. And that caused a lot of fear in the market. And the purpose is to fight inflation. So within this video, I'm going to go through a couple of articles with you. I'm going to talk about inflation in USA, inflation in Canada, and what it's going to be like in the coming months, and how inflation is going to resolve itself with or without the Federal Reserve help, and why we might actually be heading into deflation. So first of all, let's talk about how inflation is calculated. Now, what everyone cares about right now on the news is really the year-over-year monthly inflation. So, which is calculated to be the inflation index this year divided by the inflation index last year for the month. So let's say January 2022, the inflation index was 281, and January 2021 inflation index is 261, so it's 7.6%. And that's kind of alarming, and that's why Fed is increasing interest rates to fight inflation. Now, if we look past this Bloomberg article and we actually look at the data of the inflation index, scroll down here. This is actually the index across all the years, and I go all the way down. Here you can see that is the 261 I was using, and this is the 281. And if I look at the last couple of months, 296, it has actually been flat for 3 months already. So the inflation index has been flat for 3 months. And we see that June, July, August is flattened. And if we assume the inflation index is flattened, then we can project forward in the coming months. Now, the reason why I would assume that is because we see that happening in the last couple of months, and with Fed, increasing interest rate by another 75% basis point, that will further reduce the demand and the flow of the economy, and we're kind of heading towards a crash, which is reasonable to assume the supply chain crisis and all the other issues will be resolved as well. So the price index is starting to flatten. Now, what you notice is that last year, the same time, the number is actually going up. And when you're looking at this calculation, is the denominator. That's what we need to focus on. So for example, for October, if we assume it's going to be 296 again for the inflation index, and the denominator is 276, then it's 7.2%. Now I use these squarey brackets to show that this is my projected number, and the 276 is actually the actual number last year. So that 276 isn't going to change. Now in November, if we use 296 again, then it's 6.4%. And this is actually the first time you see a meaningful decrease of inflation that we can expect. And in Investing Accelerator, I also talk about hedging, which is an advanced strategy when we're investing. You can hedge until that point. Now in December, 296, that's what I'm using to calculate this projection, is 6%. So you can see the inflation year-over-year figure is actually rapidly cooling down, even if the price index stays at 296. January 5.3, February 4.5. And the reason is because you can see this numerator here, 281, 283, is going up so rapidly. Basically, if we wait long enough and the price index stays the same, then the inflation will get really close to 0%. And we can observe inflation is rapidly cooling because we assume this price index is staying the same, because Fed has increased the interest rate in a sufficient manner to combat inflation already. For the rest of the year, Fed is expected to increase the interest rate by another 1.25%, which is 0.75 in November and 0.5 in December. So for the rest of the year, we might actually experience a decline in the index, which is this 296 going down. And if that is the case, it will actually shrink inflation even faster. It means that Fed can flatten the rate sooner rather than later. Now, chances are Fed is going to overshoot this interest rate increase and cause a lot of pain in the market, and the index will decrease, which means we'll actually experience deflation. And I think deflation is what we're trying to avoid. But right now, Fed is being very aggressive, which will actually push us into the deflation territory. Now, in my opinion, I think a high interest rate hurts business and job growth. And I'm sure you see a lot of news articles that big companies like Microsoft are slowing down or stop hiring. And companies like Google or Facebook are looking to fire a percentage of their employees, like Snapchat firing 20% of their employees. And a lot of weaker economies are already suffering compared to US. And a high interest rate for USA creates a very strong US dollar, but then the rest of the other countries will suffer. And a sustained high interest rate will lead to a decline in the index, which is deflation. And if that happens, Fed will need to lower the interest rate in 2023 at a later stage or in 2024. So that's actually what people are expecting. So if I go to this Bloomberg article, then here you will see the Goldman forecast for Fed hikes, which is what I was talking about earlier. 75 basis point for November, 50 basis point for December, and 25 basis point for February. So even if you don't think about, the price index being the same, and the denominator is actually catching up, which lowers inflation, that's what the lenders are forecasting. So they are expecting some sort of peak in terms of the interest rate coming up. Now, one interesting thing is that if you have been following the Canadian economy, because I'm Canadian, you will see that the Bank of Canada is quite aggressive in increasing the interest rate, and the Bank of Canada is actually losing money for increasing the interest rates because they need to pay all this interest for this money in the savings account. And you can see this is not sustainable. So eventually Bank of Canada do need to reverse that interest rate, but they are right now planning to lose money for 3 years in a row. So this is actually quite concerning. And I think they are not going to hold on to that interest rate for 3 years. So chances are at some points they need to be kind of reversing that to a regular level. Now, for Canada compared to US, they are a little bit ahead of the curve in terms of their economy is booming and crashing faster than US, and their inflation is actually cooling down. So right now, their annual inflation rate is actually cooling down to 7% in August, which is weaker than estimate 7.3%. Now, if we go to Statistics Canada and we look at the reference period, and let me just pick 2021 to August 2022, then you can see the same inflation index that I was showing you for US, but this time for Canada. So here you can see the inflation index 140 going all the way up to 153 here. And in August, you actually see the deflation now, which is 152.6. Now, when you're thinking about the Canadian and the US economy, the difference is that the US economy is more diverse, whereas the Canadian economy has a very strong focus on commodities, gold, silver, diamond, oil, lumber. And all of these are actually crashing ahead of time compared to the rest of the economy. So when you think about the commodity boom a year or two ago, that's actually coming back to the regular level. So commodities are actually crashing right now. And this is because Canada has a lot of natural resources, which makes it a very, input focused country. And then manufacturing is kind of done in China or other locations. And then output, kind of like the real estate, goods and services are being sold in US. So then you can see if the commodities are crashing, naturally that will have less pressure on the manufacturers, which will then lead to deflation on the goods and services in the end. So Canada is actually kind of speed running through the cycle. So you can see their economy is actually not doing as well. So let me just bring you up the chart first. So what you get is Canada trying to match the US dollar in terms of interest rate increase. And the reason is because if Canada doesn't match the interest rate increase when US is increasing it, then money will easily flow from Canada to USA. So more people demanding US dollars, less people demanding Canadian dollars. So the exchange rate will move significantly. Now, previously, if you look at the Canadian US dollars from May till, let's say, June, this is during the US oil price, crude oil price being really high. So this is the oil price being really high, and that was allowing Canada to maintain its interest rate. But this is actually reversing as well because the interest rate is so high and a lot of political uncertainty as well. So this is actually causing the oil price to decline as well, and the commodity boom is also coming to an end. So a lot of the pillars that are building the Canadian economy is coming to an end, which is why you're seeing a very sharp drop in the exchange rates between the Canadian and the US economy. That's what I wanted to talk about because that's what I go through in Investing Accelerator. and then we are able to position ourselves and see where the opportunities are. So that is one of the key things that are happening if you are a Canadian investing in US. If you're a US investing in US and you're thinking about, what is the interest rate going to be, when is it going to be over, and as long as Fed is able to maintain the price index at 296, I think we're good. We just need to last till February, and the calculation will naturally be 4.5%, and then wait a couple more months, it will be down to 2%. So basically, we're near the end. We still need to push through this winter quarter. It's going to be rough, but I think we're maybe 5-6 months away. So let me know if you have any questions down below. If you like this video, that's actually what we go through within Investing Accelerator, the weekly group coaching call. So you can give me a like, so then YouTube will push this video to more people. I'll see you in the next one.